Let's bring in Michael Pond to explain to me that there's no inflation out there. Michael, all I heard all weekend was with these guys. Do you like all my stripes today?
Love it, Tom.
This is like, bring this in here, Victor. Help me out. Both of us look like we got dressed half asleep this morning. It's a major misconduct. Forget about the 2-minute minor. Stripes and stripes, and you got the logarithmic checkerboard thing. Oh, excuse me. The control room says you look good, which implies that I don't.
Everything's relative, Tom.
Do we have inflation now?
You know, we have some inflation. We have probably a little bit more than the Fed would like in normal times, but these are not normal times. So they actually want to juice the economy through a little bit higher inflation in order to avoid deflation. That's really what the Fed would be much more concerned about rather than inflation of 2.5% or 3% right now.
When you sit with Dean Mackey and with Larry Cantor, do they want to see that nominal GDP goose, which is real GDP, to hell with it, put some inflation on top of it to get us going so David Kelly's happier, who we just spoke to?
Well, you need to have the right mix, Tom. It's not just enough. It's not just good enough to have inflation if real growth is low. And that's what we had in the first quarter of this year, where gasoline spiked, real consumer spending dropped because of it. So nominal GDP was okay, but it wasn't good whatsoever.
Right.
The Fed really wants to bring inflation higher in hopes that causes spending to increase along with it.
Okay, here it is, folks. Here's GDP, here's inflation. Christina Romer and Michael Pond are hoping that you do inflation and that boosts this real GDP here.
What the Fed really wants is that for that inflation to feed not just through to goods prices, food price inflation, gasoline, but into wages. That's really the
Is there any history of that?
Well, we're getting wage inflation where the Fed and others look at the unemployment rate at around 9% and saying we just can't get wage inflation in this environment. So they're doing more and more to try to stimulate inflation and wage prices.
I love when you're on. You destroy the script. Let's bring up elegant chart 1 here. It's an elegant chart. This is brand new. This is our Michael Rosenberg chart. The Bloomberg Financial Conditions Index, which has been used worldwide. The yellow line is the U.S. index, and it's closely linked to Europe, the new one we're introducing, which is the white line, and then they decouple on the right-hand side of the chart. Does the Barclays team, do they put the Julian Callow world in with the Dean Mackey world, or can we say we're decoupled in terms of rates?
We certainly look at things from a global perspective, but right now, importantly, not just financial markets, but also data has been decoupled in the U.S. relative to Europe. We expect Europe to go into a mild recession next year, not a deep one, although there's certainly a risk of that. But we expect the U.S. growth, assuming we get a payroll tax extension, and that's certainly a key over the next couple of weeks, will be around 2.5%, which again is not great, Tom. We think potential GDP is around 2%, so 2.5 is only slightly above potential, pushing unemployment down only slightly, but still that 2.5 is much better than the negative rates that we're likely to see in Europe.
This chart, in your expertise on inflation and bonds, let's bring it up here. It's a long-term view. It's a 10-year yield back a gajillion years. And then we look forward, what is that, 15, 25, 26 years, and we zoom in on that trend. The red line is a 10-year yield, great moderation, and there's that financial repression as we come down well under 1 standard deviation below that red line. How long does the financial repression last?
Well, I think more importantly than the nominal yields here are looking at real yields. Real yields right now are at 0. On a 10-year. So the break-even rate, the gap between tips and nominal treasuries is around 2%. So that's equal to the nominal yield. You can't earn anything in real terms in U.S. treasuries out to the 10-year point, which means that the Fed is trying to push investors out into other assets, and that is certainly a form of financial repression.
Bring up too much information. Michael just talking about that. Let's bring up here the tips break-even, the 5-year break-even. And this chart shows you how we've come down. There's that disinflation trend. What does that signal to you, much like the Bloomberg Financial Conditions Index?
Well, it signals that the market's not expecting a whole lot of inflation here, around 2 to 2.5%, which is where that level is. But it's also not expecting deflation over the longer term, and it's because the Fed has increased its credibility as a deflation fighter. We think that if these levels continue to decline as they have over the past couple weeks, and the employment situation doesn't improve, QE3 is certainly back on the table, Tom.
Where should people invest now that just want to tuck it away? Where in the curve? What duration should they be in?
They really should be in on the curve and earn almost nothing.
1 year,
it really is.
It's easy for you and I to say, but that doesn't help a retiree with $122,000.
No, it doesn't at all. But if you put it into 10-year, 30-year Treasuries at 2%, 3% levels, you can get killed if rates back up. So you're much better to give up that income now and hope that yields rise over time and you can start reinvesting.
And to synthesize in Europe with the United States as well. Here's the note of the day. This is a wonderful thing. I haven't even read it all yet from HSBC. 3 of their economists in London talking about this idea, can the West inflate away its debt? If the emerging markets refuse to accept real currency appreciations, the West will be mired in a Japan-style rut of stagnant nominal activity and struggling to repay its debt. I mean, this is a nice economic question in your wheelhouse. Can you just issue more debt and inflate away through currency depreciation and the rest? Can you do that?
Well, the Treasury right now is pushing China and other emerging market economies to allow their currency to appreciate. But, the trouble they'd run into if you all of a sudden had a free-floating yuan is China wouldn't have to buy any more Treasuries.
Right.
So it's really the fact that the renminbi is stable and being kept stable.
Let's slow down. This is a break exclusive. This is really important about the linkages here of the markets. We go float the renminbi and appreciate it. Stronger renminbi hurts our exports, but that's not the story. It's about your world, isn't it?
That's right, because China has been a large buyer of U.S. Treasuries, and the reason why they come into the Treasury market isn't because they love them. It's because they have dollars to invest, and they need to put those in safe assets, U.S. Treasuries. If they were to allow their currency to appreciate significantly, say go to a fully free-floating currency, they wouldn't have to buy any more Treasuries, Tom.
Yeah, at the margin.
And that could actually push our debt costs up significantly, and we might have trouble funding our own debt situation.
Earlier this morning on Bloomberg Surveillance, I spoke with William White, formerly with the BIS, now with the OECD, and I asked Mr. White his concerns about Europe.
My worry is that the Europeans are underestimating the extent to which markets can panic and can actually do some pretty bad things in consequence. They have got the right inclinations with respect to where they want to go in Europe, but I fear that they think they have more time to do that than the markets are prepared to give them, because once the panic starts, it becomes very difficult to turn it around.
So there's William White on the immediate term. We're talking with China about long-term vistas. Let's bring it back to the Julian Callow world in the short term that you have. What are you watching this week in the bond markets?
Well, one of the things that we're watching is the payroll tax extension and the signals that we're getting from Washington as to whether we get that extension. Because if we don't, our growth forecast, frankly, will probably be dropped down from about 2.5% in Q1 down to around 1%. It's that big.
Say that again.
It could be that big of an impact if we don't get the payroll tax extension. The unemployment benefit extension is also important, but it's the payroll tax extension that's worth around $250 billion to the economy. That if that doesn't get extended, we could have a bond market rally pretty significantly into the year end.
Why are we having a 2.5% or 3%, some would say even 3.5% good feeling economy, and we're looking at a payroll tax holiday that takes that much out? It seems like it's almost 2 American economies.
Well, part of it is consumer incomes are growing, but they're growing at a fairly tepid pace, around 4.5%. So if you have that, if consumers need to pay more tax, they'll spend less. It's really as simple as that.
Michael Pond, thank you so much.